The S&P 500 showed a flat close here today, but don't let that fool you. We actually had quite a strong day if you look underneath the hood. First of all, we had very strong advancers versus decliners internally within the market. We also saw a strong showing out of some of the more cyclical areas like commodities, and we also saw the Russell 2000 small cap index pop yet again to another all-time high. So we're going to discuss a few of those things here in tonight's video. We'll then get into our trade application example, where I wanted to focus on a ride-hailing company that appears to be on the verge of breaking out. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's January 12th, 2021. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our YouTube area and sign up for our channel, and also go down below to our description area, sign up for our email distribution list. We're also heavy users of Twitter. Feel free to follow me if you're not doing so already. My handle is @BrandonVanZ, and we do appreciate those of you that click like and retweet on these market outlook related tweets. Last but not least, we do have a presence on Facebook as well. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into our charts here. And as you can see, I've got chart 4B pulled up here in front of us. And as I mentioned in the intro, you'll notice the S&P 500 actually finished flat today. It was technically up 0.04%, so about as flat as you could possibly get there. But I did want to kind of start things off with this conversation. If we come up here to the Market Watch area and then click on Visualize and then go to the Index Watch and look at the S&P 500, you'll notice that we had a very strong showing. If you look under the hood there, notice that there were 316 advancing stocks within the S&P 500 and 186 decliners. And so, I think a lot of people would have a tendency to say, okay, well, if the S&P 500 was flat today, you had about half winners and half losers, but that actually was not the case. We had a broad-based advance. It's just that the largest market cap companies were not necessarily carrying their weight the way that we had maybe been used to seeing them do so in previous months, and that's not something that's brand new, right? We've seen the smaller caps and some of the mid-cap companies carrying their weight here for the last couple of months, but I'm saying like a year ago, the story was mostly Apple and Amazon and Microsoft and those big companies that would kind of just pull the rest of the market up with it seemingly day after day. That's no longer the case. We have a broad-based advance. Many stocks that you probably never heard of are out there kind of carrying the load and hitting new highs. So, don't forget about some of the smaller companies. Now, speaking of which, down here in the lower right-hand corner, you'll notice we have the Russell 2000, and as most of you are aware, that's the small cap index in the United States, and we had quite an epic day there, up 1.77%. So again, we've been all over this story, and it's been the same story for the last 2 or 3 months at this point. So if you've been tuning into these videos, surely you know it by now, but it's still worth mentioning because it continues to be very, very impressive. On a day when the S&P 500 went exactly nowhere, we actually had a very, very strong day out of the Russell 2000. And you'll notice here by the shape of the candle that we hit an all-time high today. So notice that green flag kind of lighting up back behind the screen there. And we also closed near the highs of the session. So not only did we touch a new all-time high on an intraday basis, but we also closed with an all-time closing high. Really strong showing there. In fact, if you were to kind of compare the Russell 2000 to the other three indices on the screen in front of us here, notice the intermediate line on the Russell 2000 is at 95.56 and rising. Remember, that can only go to 100. So you're up there pretty extended at this point and pretty strong in its trend. And you compare that to the Dow Jones, which is at 91. You compare that to the S&P 500, also at 91, and then the Nasdaq Composite just a hair below 91. So there's no denying the fact that we've got the Russell 2000 leading our way higher here. In fact, I was just putting together my factor selector information, getting ready for my factor-based swing trading class tomorrow morning, and you can see here that once again size is in the top category there, and it has been the case going all the way back since the first week of November, effectively when we got that Pfizer vaccine news along with the presidential election. That's when we saw a big kind of shakeup within the market itself, and that's really when the small caps started to outperform in a major way, and it has continued to be the case every single week since then. So those of you that have some small cap allocation, either in your 401ks or perhaps your individual trading accounts, well done. It looks like that's one of the strongest areas that we've been able to uncover here recently. In terms of the other two indices, Dow Jones was up 0.19% today, and the NASDAQ Composite was up 0.28% today. So pretty quiet days for everything except for the small caps there. Now, because they weren't major meltdown days or anything along those lines, it didn't change the posture. So notice that the background colors of all four of our charts remain dark green. I think that's an important takeaway as well. I think the tendency sometimes is that you want to fade moves, right? People like the idea of saying, well, the market's got this wrong, and so I'm going to fade it. I'm going to trade against it. Whereas other people are going to take the mindset that, hey, I'm going to follow a set pathway, and knowing that the rules will never be perfect, but hopefully will be better than average. Those of you that kind of take that second approach, hopefully you have been rewarded by watching these videos each day, because your posture basically every single day since the beginning of November has been bullish, despite a lot of really ugly headline that are out there, whether it's politically or economically speaking. Lots of bad headlines that could scare the typical investor out of the market. Yet, if you're just simply trying to read the charts, understand the process, and set your posture based off of this simple mechanism that we show you here every day, you've been doing pretty well for yourself. And I know we've had a fair amount of success with using the market forecast technical indicator in my Monday top-down trend trading class as well, where our accounts hit all-time highs here today, and we've got stocks like Etsy and Uber that were just popping huge here today. And part of the reason for our success there is our recognition of how to utilize that market forecast technical indicator. So if you need additional assistance beyond these free YouTube videos, remember that's the whole point of David and I having a premium service called Market Scholars. So make sure you look into that. And also a friendly reminder to those of you that were with us back in 2018, your 3-year subscriptions are about ready to come due. Yes, time flies, and hopefully you've received emails from both David and I here the last 2 Sundays regarding the special link that we've set up for your renewal discount. So if you didn't get that, shoot us an email at support@marketscholars.com. I know sometimes emails end up getting lost or accidentally deleted or what have you. So anyway, let's go ahead and take a look at our next chart here. And you can see that, let me go ahead and pull up the 3 green arrows chart here first. You can see here that we do have 3 green arrows on all 4 of our charts here. So on this chart 4D, when you see the background color, that light green color, it means that this particular chart setup has what's known as 3 green arrows. That's using 3 different technical indicators to try to determine whether those indicators are giving you bullish signals or bearish signals. And so the 3 different technical indicators are the 30-day moving average. When price rises above the 30-day moving average, that is said to have a green arrow. We also have a green arrow on the MACD histogram, and we also have a green arrow on the stochastic. So those are kind of the 3 indicators we're looking at here, and each one of them kind of tries to point us to the same direction, although they're measuring slightly different things. And so we like to see them when they're kind of in alignment and all telling us bullish at the same time, or all telling us bearish at the same time. And at this moment in time, with charts starting in the lower left and ending in the upper right, should be no surprise that these are excellent trend trading environments that we find ourselves in, and therefore the 3 green arrows strategy has been a fairly effective one here. All right, let's go ahead and now take a look at our next chart. And in this case, we're going to look at the 1040 crossover method. This is our longer term chart here. Remember, these charts will be 3 years in length. And so it gives us a kind of a a wider view as to where we stand with things. And as I've mentioned to you guys in previous weeks and months, the one that kind of stands out to me as far as understanding where we're at is the Russell 2000, which is the chart in the lower right-hand corner here. Notice that it broke out above its prior high back here in late November. And so remember, this was the one that still had a high that had not been breached, that was still in place from back in 2018. So that was a pretty big moment there in late November of last year when we got up and through that prior resistance area there, and we've been climbing that wall of worry, so to speak, ever since then. So it's been a really strong move there. Remember, the point of this particular chart is to give us a sense of whether we have what's known as golden crosses or death crosses when we're looking at the moving averages. And so we're just looking to see, is the orange line crossing the blue line or not? The orange line is the 10-week moving average, blue line is the 40-week moving average. And as you can see, no surprise here, all four of our charts continue to have the bullish crossover or the golden cross that has taken place and has continued to push forward and even expand further as time has gone on, because momentum has not relented. We've been persistently strong within the markets, and so the less sensitive line, in this case the 10-week moving average, is able to rise at a more rapid rate than the less sensitive line, the 40-week moving average. And so when that happens, you kind of see the separation in the line there, and you kind of see it down below on the PPO as well. All right, let's go ahead and take a look at some 12 grid analysis now, starting with the asset classes. Now, before we do that, real quick, I just wanted to say thank you to those of you that help support us over on social media. Last time I did the video, looks like 102 of you clicked like there for me, and I really appreciate that. Anytime we're up in the double digits, or I'm sorry, in this case, triple digits, we're excited to see the support from our audience. So if you'd like us to do these videos as often as possible, that's your best opportunity to do that for us, is just to click like. Thank you very much for that. Anyway, back here on our charts here, you'll notice that we've got some red charts, or at least dark pink charts, and we've got some lighter pink charts. We've got some darker green charts and some lighter green charts. So this is actually a pretty good example here where I can show you all four different color schemes that we use for these 12 grids. So the way that you would read this is, if you see the dark green charts like we have for the S&P 500, EFA, the foreign developed stocks, and even the foreign emerging market stocks up above, those are all considered strongly bullish postures using the market forecast intermediate line. You'll notice that we have these intermediate labels on the charts themselves, helping us along with that conversation. So, all of them are in the 90s right now. And remember, anything above 80 is considered strongly bullish, whether it's rising or falling. That's the upper reversal zone. And so give it a little bit of leeway up there, because it's proven its worth to us, so to speak, once it gets up into that upper reversal zone. So all of those would be considered strongly bullish. Now, we do have a weekly bullish chart to show you as well. The chart in the lower left-hand corner, notice how its background color of the chart is that lighter green color. That signifies that there is a bullish intermediate posture, but it is considered weakly bullish, not strongly bullish. And that makes sense. When you look at this chart, which is the US dollar in the lower left-hand corner, that chart does not look anything like these dark green charts that I was showing you a moment ago up here at the top. If anything, UUP down below still looks like it's in a downtrend. These other ones are very clearly in uptrends and doing quite well. So it's natural that this one does not give us the same strong posture readings that the other charts did, but it is kind of reflecting the fact that we've had a little bit of a bounce here recently, and I guess that's more than I could have said about UUP for quite some time. Remember, this has been a trend that's in play for the last 3 months as we've been in this downtrend, and there has been a pretty decent sized reversion to the mean type of a bounce here, back up to that moving average. As of yesterday's close, you actually closed above the moving average. But here today, we fell back down once again. But because that was a little bit more of an aggressive move, it was enough to push the intermediate line out of the lower reversal zone. Remember, on the market forecast, lower reversal zone is 20. So with this one saying 21 and rising, it just barely got out of that lower reversal zone. One quick pro tip for those of you that have access to our charting package. Remember, if these miniature charts are too small for you, you can always right-click on the chart and then go to Maximize Sell. When you do that, you'll see a bigger version of the chart, and when you expand it, you'll then be able to see the indicator itself. When we have it on the 12 grid view, you're only seeing the labels. So if you ever wanted to kind of take a look at how does the actual indicator look, go ahead and expand those charts there. And you can kind of see what I mean here with this green line barely getting out of the lower reversal zone right now. 21 and rising, just a hair over 20 right there. So technically, that is considered weakly bullish. And it is worth noting that that is the first time that the green line has been out of the lower reversal zone since going all the way back here to mid-November. So maybe there is something to it. And again, kind of makes sense, right? If we look at some of these other reversion to the mean moves that the dollar has made in the last couple of months, you didn't come close to even touching the moving average, let alone closing above it. So this last time there was enough of a oomph that you actually got above the moving average. I think this green line is kind of reflecting that. Now, it's not a done deal yet. It doesn't mean we have a trend change on the horizon or anything along those lines. It's just kind of a heads up, you can think of it as, that, hey, this one has been a little bit stronger on its bounce. And if it is resilient at these levels and continues to pick up steam, then it might be worth paying attention to. But right now, I'm still going to assume that this pressure that the US dollar has been in for the last 3 months will likely hold. And I'll be happy to say I was wrong if that is not the case, right? And so we all have to kind of go into things with certain assumptions. And right now, with that moving average pointing lower, my assumption on this is that we still have some work to do in front of us before the U.S. dollar gets bullish again, despite the slight posture change, just barely going to weekly bullish there. So we'll keep our eye on that story. Now, in terms of the pink charts on the board, there's this kind of darker shade of pink like you see in the middle rung off to the left-hand side there. That's long-term U.S. Treasuries. Remember, we have a bearish trade going on that particular security as one of my trade application examples from a couple of weeks ago. So I, for one, am happy to see that continuing to struggle at this exact moment in time. But you will notice we have a green dot that shows up telling us that we did have an oversold cluster signal. And you don't get those all that often on TLT. You can see we had another one back here in October, and there was an immediate response to that. You'll notice that that security went up about 4 days in a row, nearly immediately after having that signal. So it is possible that we might get a little bit of a pop higher here out of TLT. So for those of you that are feeling a little bit nervous about it, perhaps this is a time to take some profits on your prior bearish trade. Or for those of you that are particularly ambitious, maybe you'll actually do something bullish in the really, really short term on TLT with the hope that it kind of rises back up to this moving average here in the next couple of weeks. So we'll see how that plays out, but be on the lookout for that possibility there. So that's that darker red or darker pink chart telling us that we have a strongly bearish posture. Notice that its intermediate line is at 7 and falling. In other words, easily in the low reversal zone. Whereas there are some other charts on the board, like down below here with gold, it's got that light pink background color. That signifies that we have a bearish posture, a bearish intermediate posture, but it would be considered weakly bearish, not strongly bearish. Again, that makes sense. You look at this chart up here, it's visually more obvious that this is a clear downtrend that we're dealing with. With gold, it's not quite as clear. It doesn't look good in either direction. It's more of a kind of a slop and chop sideways type of a chart at this moment in time. But we did have a little bit of a bounce there in gold today. Maybe it's trying to round a corner back higher. It does have a rising moving average at this point because it did some constructive work on the chart here about a week or two ago and actually was able to kind of bend that moving average back higher once again. I should also note while we're here that oil had another really good day. You'll notice that oil is up 1.8% today, and that's a chart that a lot of people have been watching. In fact, that's an area that has picked up steam not only from the commodity perspective, but also from the commodity producers perspective, or the equities that deal in the oil patch. They have been some of the stronger charts on the board here recently. In fact, we had the opportunity to look at a very interesting foreign oil company in my class on Monday for top-down trend trading. Speaking of which, let me show you here real quick that if we were to come over here to chart 1E, this is our sector selector toss version of it. Sometimes you guys see me post the Excel version of it on social media and different things like this, but this is kind of the toss version or the Thinkorswim version of it. And again, big thanks to Mike Emerson for helping me out with this data to construct this. He worked really hard on it, and I tip my hat to him. He did a great job with it. But anyway, as of Friday's close, which is traditionally when I measure the sector selector, you can see that energy closed at number 3. So notice like this brown line, it was at number 1 a few weeks ago, and then it kind of fell back, and then it started working its way back higher again, and it ended Friday in the number 3 slot. Materials in the tan line was number 1. Consumer discretionary in the blue line was number 2, and then energy was number 3, and then financials were number 4. Well, you can see here that as this week has gone on, so remember again, these kind of stopping points are each Friday. So those are your kind of official closes there. But there's these little dotted lines that you see on the chart as well that are telling us what's happening on an intra-week basis. So not just the Friday closes. Kind of gives us some idea as far as where we expect the rankings to end up by the time we look at the result again this upcoming Friday. So I wanted to point out the fact that we've only had 2 days of trading so far this week, but it has helped support the energy stocks, aka oil and gas companies, even further than they had already been supported, because they were already making a splash moving all the way into the number 3 slot. But in just the last 2 days, where things are shaking out right now, is energy is back to number 1. Again, there's 3 days left, so we don't want to etch this in stone yet. We'll find out this Friday whether they end up there, but so far so good. And a lot of that is as a result of that chart that I mentioned there to you a moment ago. The crude oil chart has been very, very strong for several months now, and I know there are people that don't want to believe it, because every time they've tried to believe the move in oil in the last 3 years, they've felt like they got burned by the hot stove. But as I mentioned to my class on Monday, this time feels a little bit more legitimate. Oil has been hanging around at the higher levels for a longer period of time than the one-off pops that it had in the last 3 years. So it feels a little bit more substantial this time, and we're seeing some pretty decent moves out of some of those types of companies. Let's take a look at the Sector 12 grid here, and I'll show you what energy kind of looks like right now. And that's the chart on the right-hand side here. Dark green background, the intermediate posture on XLE, which is the market cap weighted ETF that tracks oil and gas stocks for the S&P 500. It's at 90 and rising. That's a very strong number there. And you'll notice that it's so strong, we actually have a little red dot appearing above today's candle telling us that we've got an overbought cluster signal. Now, as you guys have heard me mention in the past, my research has led me to believe that oversold cluster signals are more valuable trading tools than overbought cluster signals. In other words, it's kind of a coin flip whether the stock will go up or down after having a overbought cluster signal. but you have a much greater chance to seeing an oversold cluster signal actually rally than that. So I'm merely pointing this out. It doesn't have to impact the chart. The chart itself looks really good. You can see that energy stocks took a little bit of time off here about a week or two ago and kind of hung out near that rising 30-day moving average line. And that was the time during the sector selector I mentioned here just a moment ago where you kind of had to fall out of that upper slot for a few weeks, kind of taking a little bit of a breather, but now they're making another run at it here. And you're seeing a nice little breakout type of behavior here on the chart with today's activity. Notice that energy was up the most out of all sectors today. It was up 3.5%, and that was enough to get us up and over this prior high back here on December 10th. So obviously this is only 3 months that we're looking at here. There's plenty of other highs that it needs to get through before it has some blue sky in front of it. That naturally happens when you have a asset class that's been so much of an underperformer over the years. You're constantly having to deal with resistance areas on the chart when you eventually start turning the corner back higher again. But at least we can say from the last 3 months perspective, things look pretty strong here for the oil and gas companies. They are breaking out, as you can see here in front of you. Now, in terms of other areas that made some moves here today, materials were also up over 1%. They were up 1.27%. Remember, that's another one of those areas that's kind of in the top 3 or 4 sectors on the sector selector right now. Both materials and energy benefit from a weak dollar environment traditionally, and that's mostly where we find ourselves right now. You also saw discretionary up 1.53% today, a very strong showing there, and then financials up just over 1%. Remember, we have now entered earnings season, and we're going to get all those big banks coming out with their earnings here later on this week, so it should be interesting to see how those shake out. We talked about one of the larger banks in the United States in my options for long-term investors class on Monday afternoon, and we're doing some selling put trades on some of those types of securities out there. So anyway, be on the lookout for those. The banks have been one of the most impressive entities from my perspective so far in 2021. There's been a lot of stories so far in this very short year that we've been living through, but from a financial markets perspective, to me, the most important thing that I've seen so far is the really, really strong behavior out of the banks. So we'll see if that can continue or not. In terms of the bearish charts that we see here from a sector perspective, we do have the communications at the top with a weekly bearish posture. It was down 1.61% today. Remember, that's the area that's going to house the social media companies. So your Twitters and your Facebooks and those types of companies that have come under pressure here recently because a lot of criticism surrounding politics. I think that's kind of pressuring communications as a whole right now. So we're going to keep our eye on that because remember, usually what you find is that communications and technology will travel in unison with one another. If we see a big breakdown in communications, it could very well put the rally we've been seeing in technology in jeopardy. So we want to keep our eye on that story there as well. And then on the downside, these have been more consistently bearish areas. Staples and real estate have been kind of just slogging along. They really haven't been making big moves here with a lot of the other sectors. And that's perfectly fine, perfectly healthy in a market like this where the market's willing to take on risk. It's kind of avoiding some of those more defensive areas of the market. But those areas do have strongly bearish postures at this moment in time. Real quick before we get to our trade application example, I thought I would show you as well on the commodities 12 grid. I wanted to point out the fact that corn went absolutely ballistic here today. Some of you will recall that I talked about that chart here a couple of weeks back in this presentation. I said, well, we don't really look at this 12 grid all that often, but the commodities were heating up, so I wanted to show that to you. And I was pointing out all the days in a row that corn had gone up. It was like 14 straight days that corn had gone higher. And then it finally was able to put in a negative day there on January 7th, but it really didn't break down. It just kind of held the line and maybe closed lower by a couple of pennies here and there on a day or two. Well, then today showed up. Take a look at this candle. This is a massive rip higher. Corn was up 6% here today. It's massive for one commodity. In fact, some of the futures contracts were like at lock limits as well. So we're seeing some pretty strong price action in not just the oil commodity that we talk about fairly regularly, but even some of the soft commodities down below. All right, let's go ahead and now get into our trade application example. And I'm going to just pull up chart 3A for this. Now, this particular trade application example actually kind of stems from Twitter. Remember, I try to keep you guys posted as far as what are my thoughts about the markets during the day. So if you're not following me already, make sure you're doing so. At Brandon Van Z is my handle. But one thing I pointed out earlier today is the Uber chart here, and it really kind of caught my eye. It says that's a really solid bounce off of the 30-day moving average, and then bursting through previous resistance on strong volume to new all-time highs for Uber textbook. Right, that's the type of behavior you want to see right here. Now, we actually own this one in my top-down trend trading class, so I'm not taking the trade here in this video right now, but I wanted to show you where my kind of trade idea came from, because its direct competitor, Lyft, looks somewhat similar. Now, the Lyft chart probably isn't quite as attractive as what we see here. I think the Uber chart has been a little bit better on a relative strength basis, as you can see kind of down below here. So of the two, I think the Uber chart looks a little bit stronger, but again, we already own this one in my other class, so I thought maybe we would shine some light upon its competitor in tonight's trade application example. And so the ticker symbol for Lyft is LYFT. And you can see here that Lyft has gone up nicely in the last 3 months. It's up 86% in the last 3 months. Yikes, that is a massive move. It doesn't really look like it on the chart, but we've been seeing so many aggressive moves across the board that this has become more commonplace. But you can see some of the attractive features from the Uber chart are also showing up here. The breakout isn't quite as clean. Nonetheless, it exists. Notice that after touching around $50, probably around this candle right here, Lyft had a really hard time getting through $50. It must have been frustrating for Lyft shareholders during this time period from about December 16th all the way through probably this candle here on January 4th. You would go up there and you'd get really close to the $50 level, and then you'd reject it, and you just couldn't advance beyond that. It seemed like the $50 level was the area where you just didn't have much traction. So then fast forward here to today, along with Uber, Lyft had some positive news there about some hookups there with politics and some of the vaccine news as well that were affecting these companies. But anyway, you can see that the stock did bounce higher here today on big volume. Notice on this chart down below, we've got this black arrow in the volume candle that is suggesting that we have at least 1.5 times the average volume being traded here today. So this is kind of one of those interesting charts where we've got a blend of a breakout and a bounce occurring at the exact same time. You don't see that all that often, but in this case, what happened was the stock went sideways for so long, the 30-day moving average eventually caught up to the stock, and once it started touching that 30-day moving average, it appears today like it's going to start using it as a launch pad higher to start establishing a newer trading zone a bit higher than where it's at today. So what I did here was just a swing trade. And I'm putting a bracket order on it. As you can see, my stop loss is a little bit lower than the candle here yesterday, and that puts my 1-for-1 reward risk opportunity up here closer to 55. Again, remember the trade is already done. I try to get that out to you guys that are premium members of Market Scholars and send it out via our Telegram Trade Alerts app, so that way you can consider the trade while the market is open and you don't have to wait until the next day to do that. So the trade's already done. If you need the trade details in terms of the price target and our stop loss, feel free to check out that Telegram app there if you're a premium member. Now, one thing I do want to point out about this, you do have an earnings announcement coming up here in early February. So I'm hoping this is a quick pop higher and get us out at our target price. Otherwise, it might very well roll over and get us out at our stop loss as well. But I'm going to make the assumption that we have a pretty tight range there. We should be able to get out before February 9th, but if we're not, we might decide to just pull the plug on the trade and not take on that earnings risk with a situation like this. Be aware it does have a overbought cluster signal here today, but it is the first one on the board, I should say, and it's pretty early in the process of establishing intermediate strength. You can also see that the blue near-term line ticked higher here. Remember on this chart 3A, this came up in an email the other day, somebody had accidentally changed this blue line to green, and so they were getting confused with one of the other charts that I had. So remember, this is meant to be blue on this particular chart. This is a chart that we use for swing trading purposes, not trend trading. So as swing traders, we use the blue near-term line for our information. Trend traders typically are going to use the green intermediate line. But our swing trading posture right now would also be considered bullish. And of course, you've got your nice hold pattern there as well, or in other words, close above the high of the low day. So a lot of interesting and attractive features to both Uber and Lyft after today's big bounce in both of them. So that's what I had for you here today. I hope you got some value out of my analysis and enjoyed the presentation. If you did, there's one simple thing I ask from you. Just simply click like on Facebook or Twitter or your social media platform of choice. Remember on Twitter, where I kind of use social media a bit more, I generally try to pin the Market Outlook tweet to the top of my timeline to make it easy for you to find if you're looking for it. But David should be back with you tomorrow. Until then, I want to wish you all the best of success with your trades and your investments. Goodbye for now.